It wasn't totally clear to me what B2B software actually meant anymore in the age of AI. Our B2B software companies just had a level of resiliency that doesn't exist in other business models. It becomes a lot harder to be objective about follow-on decisions when you're already partnered with the founder. I don't think being founder friendly means always being a yes woman. Once you start to see those early qualitative signs of product market fit emerge, those are the set of leading indicators that begin to allow you to concentrate dollars in fewer places if you can read the tea leaves, if you can take the time to do that work.
Welcome to Investing in Startups. I'm Joe Mager. Our guest this week is Ariel Winton-Jones, General Partner of the Aligned Fund. Ariel's a highly concentrated early-stage investor focused on B2B services as software. We talked about Ariel's very intentional strategy, the value of building relationships slowly, why she sticks to B2B, and why Ariel thinks platform teams are overrated. Please enjoy. Ariel, thanks so much for coming on the show.
Thanks for having me.
This should be fun. I want to start with talking about core thesis. There are different pillars, I'd say, of your strategy, but talking about the business piece side, I'd say the services as software is what really jumps out. And I'd love to start there and just get you rolling on what excites you about that premise.
If I'm being totally honest with you, Joe, like when I decided to start a fund, I did not say this is going to be a services as software fund. I had spent my entire career to date, first on the operating side, then the last 10 years in venture in B2B software. And the world was changing rapidly. I mean, it still is, but at this point, when I was getting ready to start a fund focused on B2B software, it wasn't totally clear to me what B2B software actually meant anymore in the age of AI. And so I spent probably like 9 months to a year just talking to like founders, operators, AI experts, just trying to soak up the answer to that question, which is like, what is software in the age of AI? And I knew for sure that one, people were going to keep automating things at work and like use increasing amounts of technology, not less. Two, there were going to be opportunities for software to at least help build in-house custom software, if nothing else. So like I had conviction in the market still, but again, I didn't know what form it would take. And as I spent more time with founders, what I realized was that the ones I gravitated towards when I was looking back at them in retrospect were ones where they were no longer thinking about software as a hammer that helps you DIY a solution to a problem you have, but instead a mechanism to actually solve the problem for you using AI as the intelligence layer. But it's not about necessarily building your own foundation model and like going and doing the frontier tech thing from scratch. It's more leveraging that to say, how do we make this smart software so that either we can build a tech-enabled service effectively, but AI is doing the work instead of humans to make it much more scalable, much more productized, much more high margin, or we're delivering you a piece of software that allows your human to be in the loop instead of ours. But at the end of the day, what that software is doing is delivering an end project deliverable you would have needed humans to deliver in the past and opening up the black box of like, how do we get to this answer or this solution so that your human in the loop can say, actually redirect, I don't like that, that's not what I meant, and then set the software off on a new direction. So those are kind of the two types of businesses that I think are most interesting from now on in terms of what's starting new. Look, as much as the public markets would tell us like software is fully dead, I think the reality is like you and I probably both use like non-AI native software that's going to be pretty hard to rip out of our businesses overnight.
We're recording it via Riverside right now inside
there you go.
Google, which I'm also paying a subscription for. I have multiple layers of subscriptions that we're doing this podcast through. So I agree.
Exactly. Yes. So yeah, it's not dead tomorrow. But when I think about like what I want to invest in for the next 15, 20 plus years, like that's really the type of business model that I'm getting excited about. So that's to me what services as software means.
Gotcha. I've had that conversation recently with other investors who some for their prior funds would probably describe what they did as B2B SaaS and very subscription oriented. And obviously a lot of the framing here has changed and some of the economic models. And to the economic model piece, do you have preferences or are you open to different business models around what that looks like? So for example, I know some investors who are kind of shying away from, look, we don't love per seat pricing. We prefer usage-based pricing or value-based pricing. Are you agnostic to that? Is it just a question of what's the best fit, or do you have some preferences?
Exactly. Like you hit the nail on the head in my view when you said, is it just what's the best fit? Like I'm a big believer that there's not one right way to sell software. There's not one right way to price software. Like all these things are black and white generalizations that as soon as you get so pigeonholed into like everyone should be usage based, like that's the only way I know for sure that it's probably wrong because not everything fits the same model, just in the same way that like frankly 10 years ago or even 5 years ago when I was at a B2B SaaS focused shop and we had a pretty particular lens, like everything should have recurring revenue models that look like most of it was the per seat at that time. It wasn't all. Sometimes we would see things that were more transactional in nature. Maybe the transactions happened once a quarter, but they were big transactions instead of like every week or something like that, or once a month as opposed to every day. And we had trouble pattern matching that to like what has worked before. I think at the end of the day, like what we're doing is looking for exceptions in our business. And so I am not tied to any one business model. And in fact, there was a time when I was at OpenView, we were really focused on product led growth, like in the early days of people calling it product led growth. This is like 2017, 18, 19 timeframe. And I remember I was actually interviewing someone on a podcast to bring that up here. So we'll have like a meta podcast moment.
Mm.
Christopher O'Donnell, who now runs a company called Day AI, at the time he was a chief product officer at HubSpot. He was kind of like the PLG guy. Like he had built out their, it was called Signals and Sidekick and like HubSpot Sales, basically, which became their CRM from scratch. And I asked him about product led growth. And I was kind of assuming that it was like the only way to go to market or like the best way now to go to market, right? Like there were so many advantages to it, which we can obviously talk about. And he said, I don't believe anything is the one right way to go to market in software. It's like start with the customer. How are they comfortable buying? Like who makes decisions? Does that person need to get on the phone because like they're not used to making software purchasing decisions? Is this a really big expense item for them? Do they actually need to have a conversation and ask 5 questions about the security of this thing based on their business model? Like whatever the set of considerations are, there are just some things that like nobody's going to purchase, that nobody's going to purchase self-service. And there are other things that, like nobody wants to get on the phone with, phone about. And so I think this is just another version of that where like there is no one right pricing model. But I certainly can tell you, I've been on the phone with founders before who are like, gung ho that like per seat per month is the way to price their product. And I'm looking at them like I've spent time in this market enough before and watched enough people try to do that to know that like that's probably not the way to price this product in this market. Like that is not how your customer thinks about value. And in that case, or by the way, like it's going to make it a really small market out of something that's actually creating a ton of value. And like you're not creating the opportunity to capture that value or some percentage of that value in a consistent way yourself. Like, yes, I have perspectives on it, but it's not a one size fits all perspective.
You're very intentional from all the conversations we've had, concentrated fund, mentioned you spent 9+ months having long conversations about fine-tuning aspects of the strategy before you launched. And from conversations we've had before, you talk a lot about spending a long time talking to founders before investing, understanding customer point of view in an era where money moves fairly quickly. That stands out. It's very different. Can you talk about that approach and how you put it to work?
I invest in a very low velocity way, meaning I'm a believer in like to take a step back where I'm focused is the early stages of product market fit. And when I say that, I mean the point at which there's a product in market. You've got customers who are using it and getting immense value from it. And it's not like your mom's best friend. It's actually someone who looks like the type of end customer that you want to build a big business around. So you've shown that there's something that's not just custom to one customer. Like that's a really special inflection point in this business. And so I share that context to start to answer your question to say that like once you get to that point, given there's all this rich data, but it's not data that's quantitative in nature. And therefore, you can't just figure it out by saying, give me your data room or hit me with a spreadsheet around MRR by customer by month, and I'll run a cohort analysis and see how fast you've been growing and so on and so forth. It takes time to run like true hypothesis driven diligence to validate or invalidate an investment thesis around that business. But the data exists if you can go find the right people and know what questions to ask them. And the question isn't like, hey, what do you think? It's, hey, these are the 5 things I have to believe as an independent thinker to believe that this is going to be a large enduring business. Like, let me go ask questions that help me validate or invalidate those points. And so what I focus on doing is meeting people as close to the inception stage as possible. It one gives me time to do that work. Two, allows me to meet people when they're not in fundraising pitch mode. And I actually think it makes a big difference in terms of like the foot that we start the relationship off on. And it gives me, frankly, much more authentic insight into how this person is thinking about building this business when their guard isn't up and their slide deck isn't shared on the screen. And frankly, third, it allows me to earn the right to partner with the best founders once we finish that process. Because my belief is throwing your hat in the ring during an active fundraise is a way to win sometimes, maybe, but like, I don't think it is a consistent winning strategy. I think, at least from my experience over the last 10 years doing venture, the only consistent way to have a high win rate has been to build these relationships over time and actually show rather than tell what a partnership would look like in an informal way, such that when we get down on one knee and they're at the early signs of product market fit and we're ready to go, whether it's preemptive in nature or they're deciding at that same time to run a process, like we've already demonstrated what we need to demonstrate to earn their partnership. So, anyways, that's a lot, but that's like a lot of what we do with that lead time, why we care about it. And it's not saying like, hey, we're going to require a month-long fundraising process in order to get there on a company. It's just that like we're meeting people intentionally before they're at that stage, and we're doing the work we can over that time to narrow in on who we really want to spend that deep time with and be able to put even more time, even more resources, and partner in an even more unscalable way with those few founders before we're like making the thing official.
What happens when you've started this relationship building, it's rolling, but a founder speeds along a process sooner than you might otherwise like? And maybe it's just necessity on their part, desire. Maybe there's just massive inbound demand from outside investors, whatever that looks like. Are you comfortable walking in those situations? Or do you try and just have to adapt around them?
A couple things. One is like, I'm not focused on, I have to be the insert letter here round. I'm more focused on the I need to be at the insert stage here round. And by stage, I mean what I just described as like those early signs of product market fit. And from my perspective, my job is to source at the inception stage, not or as close to it as possible, not at the early stages of product market fit, and then to just be able to elongate that period as long as I can that nobody else is looking at this thing. So like if I've done my job right from a sourcing perspective, which nobody's perfect, right? But like if I've done my job right, in most cases, I've met someone and given myself that space by nature of when I look to meet folks versus when I actually look to intercept. And sometimes people will raise around between those two points, and I'll help them raise that round. Like, I love to do that. I have a lot of friends who invest earlier stage than me and like have many times before helped them connect with folks who are a great fit for them, who I'm still tracking for once they get a little bit further along. Now, there are obviously cases where like I didn't meet someone before they got to the early stages of product market fit. And so I'm just hearing about it once they're in a fundraise or once they're about to fundraise in a month or a couple weeks. There are cases where I meet someone and they're going into a fundraise for sure. And in those cases, I guess I have a decision to make, which is like, am I going to sprint on doing the kind of work? I mean, maybe I shoot myself in the foot here because I haven't actually done it before. Like, I've actually never done that deal. If I'm being honest with you, where like I'm making a shotgun decision, I've considered it. But the choice I have to make is like, I'm probably not going to get the kind of insight on the human being, get the benefit of watching them operate over a longer period of time, how they make decisions, how they deal with challenges, how they learn, like how they're willing to recognize what they don't know versus what they do know. And like, in my view, it's super important to have founders who can look in the eyes of like what they don't know and be real about that, because that's the first step to being able to then improve upon it versus shove it under the rug and never quite get back to it because you're trying to pretend it's not a blind spot. But anyways, neither here nor there, I'm not going to get a lot of that insight that I usually get over time. And I'm going to have to condense my market work. I have sprinted on deals in the past for diligence. especially at prior firms. And the actual market work, like I've done that in a weekend before. I think I took like over 40 calls in a weekend for one company when I was at OpenView. So like you can do it. But again, you don't get the benefit of longer period of time with the human. And like it's not a surefire of a way to win. So is it possible? Yeah. In 99.5% of cases, if I'm showing up that late to the table, I usually just say, how can I help you find the right partner, to be totally honest with you. But I don't think that like hard and strict rules for the sake of hard and strict rules is the point of this whole game. So it has to be that I don't believe I can make the right decision for my highly concentrated strategy, or I'm being real with myself and saying, all right, if you need an answer today, what's the answer? And it would have to be a major yes for me to then go sprint. If it's anything but that, it's like, I'm not going to get there. All the odds are stacked against this one. So, anyways, it's a long answer to your question, but that's kind of how I'd process through it.
You're all in on B2B. I'm mostly B2B focused as well. Yay, B2B. We probably agree on the same reasons. Do you ever wonder whether you should spend more time, and this is me projecting, looking at consumer, or is your structural preference just that strong for B2B that you're not really interested in fishing around in the world of consumer?
I've talked to friends about this, in particular, one close friend who has been B2B his whole career, even longer than I have, like double as long as I have. And he was asking me the same question. And honestly, I like dipped a toe in that when I was at True. And I realized that like B2B is what I know. When I talk about getting from the 100,000 foot view to the 5,000 foot view on these companies and like really understanding them deeply, it's just super difficult to do that in the context of a business model you just don't quite understand. And some people started generalist or whatever. And so like maybe it's easier for them, or maybe they just like think about the way they make these decisions differently. But for my process, is really built around what I know of B2B business models. It's a lot of the same principles just applied to different markets. And frankly, even within those markets, there's only so many large enough. Like maybe there's a few more that are becoming large enough because we can capture more value through labor spend in AI, or just create more value. And as a result, you can capture more as a percentage of ROI. Like at the end of the day, I know what questions to even start asking, like what those hypotheses should be that I'll test. I just don't know that for consumer. Like it's just not where I've spent my career at all. And if I'm making the argument to myself and to my LPs that I can make higher hit rate decisions by nature of getting from that 100,000 foot view to the 5,000 foot view on fewer opportunities, like I just can't credibly make that argument in B2B. I would also say that my learning when I did this a little bit at True is like, it's where my network lies in B2B. So when I think about being helpful, like, sure, I've sat on the boards of several B2B companies. I have worked in a B2B company. I have looked at thousands of B2B companies. Like at the end of the day, a lot of the ways I provide value to founders, one is like by being their trusted sounding board, but the other is by like connecting them with the exact right person at the exact right moment. I could pretty credibly say that I can do that in B2B. Like any problem that you're having, even if it's super nuanced, I probably know a person who's at like one of the iconic companies that solved that problem and could be like, hey, let me introduce you to that person who solved that problem there. I cannot do that in consumer. Like, quickly learned that when I dipped a toe. And then the last thing is like, I lived through 21 to 23 at a generalist firm and pretty quickly realized through the dip that our B2B software companies just had a level of resiliency that doesn't exist in other business models.
They're hard to kill.
And yeah, I mean, you could just cut spend to effectively zero, be super capital efficient. It's just a cheaper to scale business. There's like a really clear playbook. Obviously, these things tweak and change, but there's just rules of the road that frankly just work to build really efficiently scaling businesses. I know we talked about that a lot at OpenView, where we were only B2B software focused, but it was only when I saw it in like a much broader generalist world that I was like, whoa, there's a reason everyone's been saying this for so long. So yeah, I'm not saying you can't build an interesting firm around consumer. I just don't see, I'm not that person. And I'm not sure this strategy is a strategy either. Like, I'm not sure. I haven't been a consumer investor, so I can't say, but like, I don't know that I would go this concentrated at this stage in consumer because frankly, like consumers are just more fickle. And so there's a little bit of a X factor to deal with that I'm just not sure I would know how to deal with.
No, that makes sense. To that point, you mentioned earlier highly concentrated. We talked about that before offline. Was there a
Yeah.
spark or moment when you said to yourself, yeah, this concentration thing is for me? This is what I'm about.
So I started doing it not realizing that it was unique, to be honest, in the sense that I started doing it at OpenView where we just ran a really concentrated model. We probably made like somewhere between 1 and 5 investments a year while I was there. And so I grew up in concentrated venture and I fell backwards into OpenView in the sense that I was operating before and like the stars just aligned. They were looking for a product manager to join their investment team and I tried it out. And so as a result, it's not like I looked at a bunch of different models in venture and said like, I'm a concentrated gal. I just like, ended up there and that's where I learned the rules of the road. And I think that the double down moment for me probably came at the end of my True Ventures experience when I saw the difference in like a much more diversified model where we made a lot more investments. And I realized that, so at True, I was focused on investing in post revenue software companies. So very similar to where I had been focused, in my earlier venture career. But the firm was really built around like inception stage generalist companies. And that was where I saw this sort of like difference in what strategy I thought made sense from a concentration level in the stage where I've always focused of business exclusively in B2B software versus that people and idea stage. And I think it helped me crystallize this point in between that I had frankly gravitated towards at both OpenView and True, where I mentioned earlier, it's the first point where that set of leading indicators begins to emerge because there are qualitative signs of product market fit. And I think those are often undervalued. I think a lot of people think of either you're an early stage investor and you have to be like super high velocity, super diversified, and let the law of large numbers govern your returns. And you're indexing like some area of some market where you believe there's opportunity. And then if you make enough bets in that area, then like you will therefore drive consistent returns. Or you wait till the growth stage where you've got a well-oiled machine, you've got something that's humming and working, you can see it in a spreadsheet, and then you can start to concentrate dollars. But my belief was just that there was this undervalued point in between where, once you start to see those early qualitative signs of product market fit emerge, those are the set of leading indicators that begin to allow you to concentrate dollars in fewer places if you can read the tea leaves, if you can take the time to do that work. And so as a result, starting the Align Fund and trying to conceptualize like, what were my learnings? How can I put really like a finger on the pulse of what I've been circling around this whole time? And frankly, it took some friends saying it back to me too. Like, this is the kind of investor you've been for the last 7 years or whatever it was at that point for me to realize like, oh, okay, like that is kind of a hot take, but it's also really core to my process. That's when I realized.
Yeah, no, I love it. I love it. Just end to end, very intentional process in a space where I'm finding a lot of people who are not, especially, frankly. And I enjoy that and I appreciate that. We've talked about reserves before. You keep that pretty low. Can you talk about why that's the case?
Yeah, so I ran my fund model every which way when I was getting ready to start the firm. Now it's going to sound like a joke that I overthink everything. I ran it every way. And I realized that I made the decision both for dollars and cents reasons, but also like in terms of what I saw on a spreadsheet, but also from a practical, like, here's what I've experienced perspective. So here was my take. My last two firms had really high reserves, which I think is pretty common, especially for funds of those sizes. I realized a few things. One is I am an expert at investing at the stage where I enter. I have made growth stage reserves, like follow on decisions. I can build an Excel model. I can do the technical underlying work. But at the end of the day, especially with the valuations that companies are seeing, frankly, like Series B onward, which I used to enter at Series Bs sometimes, in the open view days. But like from that point onwards, it's a different calculus, right? Like a lot of times you're talking about billion-dollar plus type valuations if these are the companies you truly want to be doubling down in because something's working. And there's just so much capital in the ecosystem these days that these prices get driven up. Like, I'm just not sure that I'm an expert in understanding what's going to go from 1 billion to 10 billion in X timeline. Like, that's just not the business I'm running. So that's point one. Point two is it becomes a lot harder to be objective about follow-on decisions when you're already partnered with the founder. And it is just so much easier to say yes than to say no. And the more of your fund that goes into reserves, the more those dollars impact your returns. So, like, if it's not a nominal amount of your fund, it is not a nominal impact on how your fund performs. So that's really important. And then third, I would say is I realize that you don't pick the price for the follow-on. So I'll give an example in a concentrated fund. Let's say I'm in 8 to 10 companies in fund one, and the top one or two are where I should theoretically be concentrating my reserves dollars if I had a higher reserve strategy at least. And as a result, if that company trades at 3 billion and I have reserves left, I need to put those reserves in at 3 billion. And one, they're buying me very little of that business with the kinds of reserves I would have with my fund size. And two, it changes my cost basis in a way that's like, actually, I don't want to do that. But what am I going to do? Put it in the less strong performing company? It's like you're kind of darned if you do, darned if you don't. And so I'd rather just focus where I'm pricing the deal, where I know how to evaluate the opportunity, where I can be completely objective. And then my reserve strategy is if I'm going to be a lead or co-lead investor, I have to have something, at least at the next round, to be able to participate where it makes sense. I don't think being founder friendly means always being a yes woman. So, like, I'm not saying I'm always going to write that check. And by the way, I have a low reserve strategy in general, as previously discussed. So it's not like I have infinite dollars to spend there. But I thought that was the place where it was sort of like minimum viable reserve strategy. And past that, like, I'm going to focus on what I know best.
What's something you've changed your mind about in the last few years?
I've changed my mind about a million things, I'm sure. But the first one that comes to mind is when I started this firm, I almost didn't start it alone. My husband honestly gave me the kick in the butt that I needed, where he was like, are you going to sit around for 2.5 years until the right person is ready to go? Like, obviously, this is theoretical. Or are you going to like just go build the thing that you already have such strong conviction you want to build? And by the way, part of my belief was like, if I build this thing the way I envision it, that great people will want to work here. And it's going to be a talent magnet, structurally speaking. But anyways, when I started, I thought, I used to say like, I don't know exactly how I worded it, but basically, like, I didn't want to be a solo GP forever. I was pretty clear on that. And I'm not saying that I definitely do want to be a solo GP forever, but I think I realized the two fears I had were one, that I needed people to externally process my ideas and thoughts with to make sure that I was covering blind spots. And two, that I was going to feel this need to like share the burden. And it was going to be really hard to do it alone. And I'm not saying anything about it is not hard, but I found that it takes a village, but also the village has been there 1,000 times more than I could have imagined. And that I think a big learning was, and one of my mentors likes to say this to me, and he especially said it to me a lot early, is like, you're not taking from me when you call me, you're giving. Like, I'm getting energy out of this conversation. I enjoy being a part of this process. And I've been so lucky to have so many people who are excited to be that person in any given situation or one of those people. And so as a result, I found that I actually can get a lot of different perspectives, and I actually can feel a lessening of the fear-based burden by just hearing people's support in a way that doesn't make me feel like, oh my gosh, doing this without a partner is just a brutality. And in other ways, I think I've learned that like there's a lot of value to expediency and being able to think in non-traditional ways by nature of being, I'm not alone. I have a teammate who like saves my life, but on the investment side, I am alone. And I think that has been really valuable in ways I didn't imagine. So anyways, it's one thing I was wrong on maybe going in, but we'll see where I end up.
Do you have a favorite question you love to ask founders?
I start every meeting the same way, pretty much, which maybe this is like spoiler alert. It'll feel less authentic the next time I say it to someone. I'm not saying it in an authentic way, but like I always say to founders on a first call, if there's nothing else we talk about, I just want to hear about you and why you're doing this. One, I think is like such important context. And it's sort of like when you jump into a data analysis but haven't asked the right underlying questions, you don't even know how to interpret the data. Like I feel the same way about trying to evaluate a company when I don't really understand the why behind it and the genesis and the like how it came into existence. And so That's the question I usually spend a whole first meeting on, or sometimes it turns into others from there. It depends how much context there is and how much back and forth comes out of it. But I find that to be incredibly insightful. And there are so many, again, like I'm going to say qualitative learnings, but I'm probably overusing that at this point. There are so many learnings and like nuggets about a person and the market need and how much pull there really is and how much domain expertise they really have and so much you learn from, I find, asking that question. So that's always where I start.
What's a conventional view in venture you think is bullshit?
I've probably beat a dead horse on some of these, but I would say one is probably like the only way to do early stage is to play the law of large numbers game and like index a part of the market. It's the only way to consistently drive returns. I think that's probably true when you're betting just on people and ideas, but I also think like early stage is a spectrum. And I think it's undervalued how much more data you get in like the early days of having a product in market, which frankly, I think is where a lot of seed funds are focused today, anyways, or in deploying capital today, anyways. So that's one piece. The other is, and we haven't talked as much about this, but like the best way to help founders is to develop a platform team and like a platform that scales support. I don't mean to be like a fiery hot take or like to poop on anyone, rain on anyone's parade, but I don't know what I found personally from doing this job myself, from having really deep relationships with a lot of founders, both as friends and as people I've worked with professionally, is that the most valuable things are pretty bespoke in nature and are rooted in deep trust and understanding. And the more that you try to build that bench of like, this is what we give everyone when they have a sales problem. This is what we give everyone when they have a marketing problem, whether it be a person, an expert, a set of experts, a book that tells you what to do. Like the more generic it becomes and the less valuable it then inherently is. And oftentimes the devil's in the details of where people have questions. And I think that those nuances are everything. And so I've kind of always leaned towards, instead of having like a generalized platform or a bench of like these 5 people I can go to, instead, how do I like have a ton of tentacles out in the world of really exceptional people in software who want to stay close to me and the firm for all sorts of different reasons. And we can leverage those people and frankly add value to both them and the founders by connecting them at the right point in time on the right topics that are hyper specific. And I just think that tends to be so much more valuable than like the platform approach, which has become so common. And at the end of the day, what that is like a way to try to scale something that in my belief is like inherently unscalable in many ways.
Well, Ariel, this was really fun conversation. I always love talking to you, and thanks so much for coming on the show.
For sure. Thanks for having me.
Thanks for listening to the show. If you're enjoying it so far, please tell a friend or give the show a 5-star rating. It helps. One more thing. Investing in startups does not have sponsors, but I want to give a shout out to one of our portfolio companies, Packsmith. Packsmith is the all-in-one e-commerce platform built for brands. With unparalleled transparency into your fulfillment operations, unique packaging customization options, and up to 80% faster delivery at rates your 3PL could never match, Packsmith is a logistics solution built for the future of e-commerce. If you're a growing e-commerce brand on Shopify looking to optimize your brand's distribution and sales for scale, head to packsmith.io to learn more. Thanks again for listening.
Joe Mager is the founder and managing partner of Seaplane Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Seaplane Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.